Kai, for the introduction. This section will just briefly run through our expectations for the rest of 2020. At the start of the year, we actually came in with certain expectations for key macroeconomic indicators and for the market. However, in light of recent events, specifically the COVID-19 pandemic and the decline in crude oil prices, we've had to review some of these expectations, and what we'll be sharing over the next 3 slides would largely be our expectations for these indicators and then possible potential market triggers through the year. Starting with crude oil prices. The expectation this year was that crude oil prices should remain somewhat stable around the $60 per barrel levels. However, because of the COVID-19 pandemic, which resulted in a slowdown in economic activity, there's been a sharp drop in demand for crude oil. And as a result of that, we've seen crude oil prices move down. Over the Easter holiday, there was the news that came out that OPEC and its allies had agreed to cut crude oil production. However, the market crude oil prices haven't really reacted positively, and we believe that's largely because cuts by OPEC and its allies are viewed as not deep enough to mute the impact of the drop-off in demand. And hinged on this, our expectation is that crude oil prices for the rest of the year should remain depressed, significantly lower than what we saw last year. So as at now, crude oil prices are lower by about 58% year to date. We think that crude oil prices would most likely remain around current levels through the rest of the year. For GDP, we actually now expect some form of contraction in GDP this year. In light of recent events, the federal government has been struggling to sell its crude, and we expect that to impact oil sector GDP. Now, on the non-oil sector side, there are also certain sectors such as manufacturing, trade, travel, and some sections of the services sector we expect to take a hit due to the recent lockdowns that have been put in place in Lagos, Ogun, and Abuja. And I think in more recent news, we've heard about some state governments who on their own have decided to implement some social distancing measures, which we expect to reduce economic activity. And as a result of that, we actually do think that the possibility of a recession this year is actually very likely. With regards to the fiscal deficit, we actually expect to see this expand. And that's largely because of pressure on federal government revenues. Crude oil prices are significantly lower now, as we've mentioned. The federal government is also struggling to sell its crude, and because of that, we actually expect some additional pressure on oil revenues. On the non-oil side, because of what is going on now, slowdown in economic activity, we actually expect a lot of companies to come out with downward revisions to their earning estimates. What this means is that government would most likely be getting in lower tax revenues as a result of this. For currency, we actually think that there could be a further devaluation sometime this year. So we know that there's already been some sort of devaluation already, with the official FX rates moving from about 305, 306 to 360, and then rates in the I and EFX window moving from around 366 to 380. We believe that had to happen given lower oil revenues and most likely pressures from within to increase naira receipts for the federal government, given fiscal pressures that the government is currently facing. If crude oil prices remain significantly low, and if demand doesn't pick up somewhat. We actually do think that the CBN might be under pressure, to devalue further to boost at least Naira revenues to the federal government. With regards to inflation, we actually came into the year expecting inflation to trend higher, but in light of recent events, we actually think that could happen faster than we anticipated. In addition to the border closures that came in towards the end of last year, we now have a devaluation that has occurred, and this is expected to push inflation higher. And of course, the panic buying that has happened over the last 2 to 3 weeks has also resulted in an artificial increase in food prices, which should put pressure on inflation. We note that the VAT hike, as well as the increase in electricity tariffs have been suspended for now. However, if those discussions are brought back, there's a possibility that this, could also put further pressure on inflation. On the monetary policy rate, we actually do think that could most likely remain stable at 13.5 through the rest of the year. And that's largely because of FX concerns. So while in other developed markets, we've seen central banks ease monetary policy, we've seen benchmark rates decline. I think our own central bank is in a peculiar position where they're turning between keeping currency stable as well as trying to prop up the economy. However, we know that the CBN has come out with some other palliative measures to sort of support the economy at that end, and we think that they would leave this rate largely stable, given the body language from the CBN with regards to FX, wanting to keep the currency stable. On our market expectations for the rest of the year, with regard to equities, we actually do think that there's a very large possibility that the equities market will remain in negative. Last year, the market closed down was in negative territory, and that was largely on the back of increased foreign investor selling. At that point, we didn't have the new risks that we have now, which is the significantly lower oil prices and, of course, the COVID-19 pandemic. So in view of all this, given the growing risk of sentiment globally, as well as the weak macroeconomic backdrop, lower crude oil prices, and concerns that there could be a further devaluation of the Naira, we actually think that we would most likely see foreign institutional investors remain net sellers, and the equities markets most likely remain depressed. For the fixed income market, we have that sidebar arrow there because whilst we acknowledge that the current fixed income prices are overvalued at current levels, given the macroeconomic situation we're in, we also recognize that there's a interplay here of demand and supply, in the sense that there's a lot of demand, largely from pension fund administrators who are restricted to investing in Nigeria, who have been excluded from the OMO market, and the corporate bond space is also very, very small. As a result of that, the federal government right now the federal government is the only source of domestic fixed income instruments to the market. Now, in the situation where supply from the federal government is not as high as we anticipated, given the fiscal deficit, or given our expectations of the need to fund locally in view of widening fiscal deficits, there's a possibility that fixed income rates might not inch up as higher as we had, as we anticipate or as we expect. Secondly, there's also CBN in the whole mix. So we've seen CBN in time past come up with different policies that have, changed dynamics within the market, and in a way, put a lid on how high fixed income rates have gone up. So I think that largely explains why we have that sidebar arrow there. With regards to real estate, we actually do think that the real estate market would contract this year, largely due to a slowdown in investment from both the federal government and private sector. Having said all this, we also recognize that there are certain key triggers certain key triggers, certain events that could happen, that would improve our outlook with regards different asset classes. For fixed income yields and for reserves, as I've mentioned in previously, there's a possibility that the federal government will be able to mobilize some funding from multilateral agencies. If they're able to do this, it should provide some support to reserves. This could also help CBN most likely keep currency sort of stable rather than being under pressure to devalue. Also, if crude oil prices rise faster than we anticipate, we should see an improvement in accretion in the reserves and at least improve the CBN's ammunition or firepower and their ability to keep the currency relatively stable. For fixed income, I won't repeat what I said earlier, but like I've mentioned, there's the expectation that multilateral funding may come in and reduce the FG's dependence on local borrowings to fund this deficit. For the equities market, key triggers we see are a further currency devaluation to levels more reflective of fundamentals. And we actually do believe that this could provide some support or improve investor, especially foreign investor, appetite in Nigerian equities. Also, in a situation where the COVID-19 pandemic is contained and then there's a pickup in economic activity, we actually do believe that there will be an increased appetite for risky assets, and we could see the Nigerian equity markets benefit from it. In all, that's our view with regards to our expectations for the market. I'll be handing over to my colleague Tayo, who will be talking to us about what we should be doing at times like this, given all the uncertainty and of course concerns from investors and our clients with regards what they would be doing. Tayo would be talking through what we should be doing at times like this. Thank you so much.